video discusses forecasting the required balance sheet items for a cash flow forecast for a project. We'll continue the example on HomeNet that we started in the last video. We'll need to forecast two things. One is the net working capital that will be tied up in the project. As we develop a project, we may tie up some cash. Most likely we'll tie up some money in inventory, in accounts receivable, and we may get some funding through accounts payable. Now, the rules are you should only include items that are necessary to support the project. And then we'll look at net working capital, which is the cash required to be tied up in the project, if any inventories you build up in accounts receivable minus accounts payable. Now, every time working capital goes up, it requires a cash outflow on the part of the investors. So, for example, if you're building up inventories, you have to pay for the inventories and the production process to build up those inventories. It's a cash outflow. When you sell the inventories, it's a cash inflow. So the change in net working capital results in a cash flow for the investors in a project. Now, with HomeNet, they are going to contract out production. This means that they have no cash and no inventory, but they do have accounts receivable and accounts payable, receivables and payables. They forecast each of these as a constant percentage of sales, so they use the percent of sales method for forecasting these. There we go. So what I'll do is show you how they're calculated. The receivables are calculated as 15% of sales every year. So it's 15%. Sales were going to be 23.5. Now that's after the cannibalization. So the implicit assumption here is the accounts receivable on the new project and the accounts receivable on the old project are at the same rate. If that's true, then the accounts receivable will be 35.25. And we make the same assumption on payables, that the new project and the old project, they come at the same rate. 15% of cost of goods sold. Remember, cost of goods sold after cannibalization was $9,500, and so the accounts payable 15% of $9,500 is $1,425. And so our net working capital, take the short-term assets minus the short-term liabilities, do the subtraction here, and you get 2,100. Okay. That 2,100 holds for the entire project until the end. The cash flow resulting from the working capital is due to the change in working capital. So starting at period 0 and going to period 1, our accounts receivable and our accounts payable will both go from 0 to 35.25, 14.25 for a net of 2,100. Then they'll stay the same until the end, when the net working capital drops back to 0 because we pay off our accounts payable and we collect on our accounts receivable. When we have an increase in working capital, this will be a negative cash flow. And when we have a decrease in working capital at the end, it will be a positive cash flow for our company. In addition, we'll have to make some capital expenditures. Now, on the balance sheet, capital expenditures are going to be defined to be the property, plant, and equipment this year, minus what we would have forecast based upon last year's level and the depreciation that occurs over the course of this year. So, in our example, the capital investment is a lumpy investment because we make an investment at the beginning of $7,500,000. Sometimes we assume the capital investment is continuous. As we increase sales, we forecast net property, plant, and equipment as a fraction of sales, and then compute from the net property, plant, and equipment this year as a fraction of sales this year, last year as a fraction of sales last year, and the depreciation, what the necessary investment is in property, plant, and equipment to support the sales every year. It's also the case that when we sell a capital asset, there may be a capital investment cash flow. What we do when we sell a capital asset is we divide the sale price into two parts for tax purposes. The first part is the decrease in book value of the assets. This appears in the balance sheet, and only on the balance sheet. It has no implications for recorded net income or taxes. Now, the difference between the book value and the sale price is recorded as a capital gain or loss because it is taxed, and it appears on the income statement. So, for example, suppose that HomeNet takes the investment of $7,500,000 today, depreciates a straight line over the 5 years of its life to a value of 0, but then at the end is able to sell it for $2 million. Well, on the books at the end of 5 years, the book value of the asset is 0 because they sold the asset. And on the books, the book value should have been 0 based upon last year's value and depreciation. So there's 0 capital expenditures as a result of this sale. However, the $2 million is a value over and above the depreciated value of the asset. You'll be taxed on this difference as a capital gain, and the tax is known as the depreciation recapture. The idea is you've written down the value of the asset and subtracted those depreciation numbers from your taxable income. Well, in fact, the value of the asset was more than what you depreciated it to, so you'll pay income taxes on the difference, and it recaptures the depreciation expense that you've written off in prior periods. And if the sale price is less than the book value, then you have a capital loss because you haven't depreciated your asset fast enough. So let's give you an example from the real world. This actually came when I was teaching in Newton, when a farmer who was in my class was thinking about buying a combine. So suppose that you're thinking about buying a combine for $300,000, depreciate it straight line over a 6-year useful life, but you think that you'll be able to sell it after 3 years for $200,000. What's the book value of the asset at every date? What's the taxable capital gain or loss at the end? What's the cash flow that you get? So I'll illustrate why we divide up the capital gain or losses and the book value sale of the asset into two parts. Okay, first of all, when we buy the combine, it's worth $300,000. If we write off a sixth of that every year, depreciation is $50 every year. So then what happens is 300 minus 50 is equal to 250. Minus 50 is equal to 200. Minus 50 would equal 150. But because we sell the asset in year 3, the book value of the asset actually drops all the way to 0. If we were to compute the capital expenditure based upon this, the capital expenditure on the books would appear to be net property, plant, and equipment at the end of year 3, 0, minus what we should have had based upon end of year 2 property, plant, and equipment, minus what was depreciated in year 3. Calculate that out, you get minus 150. We also have a capital gain. The capital gain is we sold something for 200 that in theory was worth 150. So we have a capital gain of 50. This divides up the sale price into the 150 and 50 for us. So by formula, the unlevered net income resulting from this sale is the taxable capital gain Supposing our tax rate is 35%, the after-tax gain is $32.50. Our free cash flow will recognize that we have unlevered net income of $32.50 and that we also have this untaxed revenue as a result of selling the book value of the assets of the combine. The way that's recorded is a negative capital investment, and we subtract the negative capital investment, but notice that it's untaxed. So the cash flow resulting from this sale is $182.50. Now you could do this as an alternative calculation. You figure your taxes based upon the taxable income. 35% is $17.50. And then your cash flow is the revenue that you get from selling the combine minus taxes. Now this is a second way to calculate it, and it may make more intuitive sense. It's a great second check on your original calculation, but this is actually the calculation that gets registered on the books of the company, and this calculation will be consistent to all of the prior capital investments and all of the other cash flow calculations that we'll make over the life of a project. You actually want to calculate it this way, and then check it this way.